5,000 options contracts, 3,000, 2,000, all done at 9:59 at the 47-second mark. What is this large institutional investor doing with Turtle Beach? After reporting earnings today, May 5, 1:40 p.m., it has since rallied 17%. And so in this video, we are going to go over this unusual option activity and then analyze it and show you how we are going to trade this based on these unusual options. So let's get to it. First off, you'll see here that the price, keep a note of the prices. They're very important because we believe what they're doing here is that when they, what they're doing with the 11 strike calls is that they're buying this. Okay, they're buying it to close it. How do we know they're closing it? We look over here on the chain. We'll see here that the 11 strike calls, the volume is less than the open interest. So they're closing, part of this is in here. It's less than the open interest. So they're buying it to close this up, and they're opening up the 12 strike calls. And you'll see that because the volume here is greater than the open interest. So they're basically rolling the 11s to the 12s. And so you'll see that here. Rolling the 11 to the 12s. Buying to close, selling to open the 12 calls. And then for the October 20s, you'll see that here. We believe they're taking the 11 strike, the 15 strike calls, and they are also closing this one out, selling this one, selling it to close, and then buying the 17 strikes to open. Okay? And so what, how do we know all of this? One way is, as we mentioned, look at the price. So let's do a quick calculation here. Now, we said that the 11 strikes, they bought this to close it. So they bought this and they sold this, right? And so we have one, if they bought it, they would have to spend 1.9, and they sold that, so they collecting a credit 1.35. Now we're at 55. And now for the other leg, we said they were selling this 15 strike calls and buying the 17 strike calls with this. So if they sold this 1.25, we would subtract that out again to collect that credit. And now if they're buying that 0.7, what do? You add that in, 0.1, 0.7. Exactly a zero, net zero. So this trade was a net zero trade. And so by paying attention to these prices, you can discover certain things about what these large institutions are doing. And so when you construct this trade, you'll see that if we look at their opening orders now, is that they've have this 12 strike call opened at selling, and then they have the Octobers where they have the 17 strike calls bought as open. And so if we analyze this trade at this current time period, this is what it looks like. Currently it's trading at 13.15, and so as the price goes down, it will be profitable because it is above the zero profit loss line on the y-axis. And if it goes up, it will be a loss. However, the break even is over here. So it can go up to about 13.52. You see that here? And it'll still break even at expiration on June 16. And so this is slightly bearish, right? And taking a risk reduction approach to it. So because if it rallies to 13.5, they can still cut their losses there. So there is a built-in hedge. When we look at the Greeks, it's positive theta, positive vega, a negative delta. Okay, so keep that in mind. We're going to construct and show you what our trade was based on these unusual options. And so because it's a 13.5, what we did was, instead of buying the 17 strike calls, we did not do that. We bought the 15 strike calls because the volatility here is quite high at 76%, because this large institution bought 5,000 of them and it had raised the volatility quite high. So we don't want to pay that extra premium. You'll see the extrinsic value is 1.6, right? It's much more than this 1.4 that you could get at the 15 strikes. And we don't want to buy as so much extrinsic value. If we can get a lower extrinsic value, that's better, because extrinsic value is the cost of the option itself. So we bought that 15 strike call. And then for the Junes, we sold the 12 strike calls. You'll see that here. This is what they also did. And so for our trade now, what does it look like? It looks the same, right? Because it's a 3-point wide call spread, it is a $300 buying power. And so you can reduce that buying power by adjusting your strikes. But you'll also notice for our trade, what is our break even? 13.66. So it gives us a little bit even more room to the upside to not lose on this trade. That's why we like this trade. And when we look at our Greeks, it's also positive theta, positive vega, right? Positive vega is good because if we expect a drop down, volatility will increase, most likely. So this trade, if we look at it, and we look at the 13.5, and we zoom out, well, Turtle Beach hasn't really ever hit 13. It's on a high, right? So let's see, was there any time, there we are, we are in this range around here where there was this resistance here back in 2022 of August, around this price point of this 13 mark. You'll see here $14 here. It hit this price here. Zoom in here. You'll see here this was a resistance here. What is this? Around 13.8 as well here, and a gap down. So this area is quite strong resistance. And so as we are now reapproaching this level, that is why this large investor has their break even set at around that level. And that's why we are also going to do that. And so that is our trade. So I hope you learned something. Please smash that like button, subscribe, and hit the bell icon. You will be notified whenever we see unusual options. And comment below on what you think about Turtle Beach.